They just smashed silver again overnight, while headlines screamed about a breakthrough battery chemistry and a calm bond market. And if you think that drop was accidental or market-driven, you are already trapped, because the banks are lying to you. And what you are watching is not price discovery, but a controlled demolition designed to disguise a reset that has already been triggered. And I'm saying this carefully because every time this happens, the same paper game is played. Futures are dumped at illiquid hours, stops are hunted, sentiment is crushed, and the public is trained to believe that nothing is wrong. But beneath that noise sits one hidden detail the mainstream refuses to touch. The physical reality of silver inventories is no longer compatible with the promises written on paper. And once you see that mismatch, you realize we are not approaching a squeeze, we are already inside a liquidity trap that mathematically cannot resolve at current prices, because what looks like a price drop is actually the final phase of a suppression cycle before a repricing event that behaves like a nuclear bomb in slow motion. And here is the secret detail they don't want discussed. Industrial demand is no longer cyclical, it is structural, and the chemistry of modern energy, electronics, and military systems does not substitute silver, it consumes it irreversibly, meaning every ounce burned into panels, missiles, grids, and medical systems is gone forever. Yet the paper market treats silver like an endlessly recyclable financial token, which is why this disconnect has reached mathematical certainty. And to understand why 150 silver is not a fantasy, but a reset level, you have to simplify one ugly mechanism: central bank collateral plumbing. Because silver and gold are not traded primarily as metals anymore, they are traded as balance sheet shock absorbers. And when rates rose, the system leaned harder on rehypothecation, stacking the same bar under dozens of claims, and that worked until delivery requests stopped being theoretical, because the moment physical drawdowns accelerate, the whole structure flips. And that is what the latest data quietly shows, not in headlines, but in warehouse outflows, lease rate spikes, and backwardation whispers. And while commentators laughed about a price smash, the insiders noticed that eligible inventories were being reclassified, moved, and pledged, which is a red flag you only see right before a rupture. And this is where the banks need you distracted by battery tech headlines and geopolitical noise. Because if you follow the math, the game ends quickly. Global mine supply sits around 800 million ounces a year on a good day. Recycling adds maybe 200 million if prices incentivize it. But industrial demand alone is pushing past 900 million, and that's before investment demand even wakes up, which means the system already runs a structural deficit that can only be hidden by drawing down stockpiles. And those stockpiles are finite, unevenly distributed, and largely already spoken for. So when you hear analysts say silver is abundant, they are conflating geological abundance with deliverable inventory, which is like confusing oil in the ground with gasoline in your tank. And the reason gold matters in this conversation is because gold is the signal. Silver is the pressure valve, and when gold is allowed to drift higher, it pulls silver into the spotlight, which is why every gold rally is met with a silver smash, because silver is the market that breaks things. It is cheaper, more volatile, and more tightly linked to real-world consumption, making it the weak point in the paper fortress. And now I need to pause and issue a warning, because you're going to see other channels suddenly parroting this narrative with the same AI avatar, the same cadence, and suspiciously similar phrases. And that is not coincidence, it's copycatting. And if you care about understanding rather than hype, you should be staying with the original, because the difference between analysis and noise is timing and depth is where the math lives. So let's overwhelm the doubt with numbers. Imagine global investment demand reawakens modestly, not mania, just 50 million people worldwide deciding to allocate 1 ounce each over a year as inflation protection. That alone is 50 million ounces that do not exist in surplus. Add to that sovereign stockpiling at a conservative 20 million ounces, and now layer industrial growth at a mere 5%, you are staring at a deficit north of 100 million ounces annually. And deficits compound. They don't reset, because once inventories are gone, the price must rise to ration demand. And here is where the $150 number stops sounding crazy and starts sounding conservative, because price is not set by average cost of production. It is set by the marginal ounce that refuses to sell. And when that ounce belongs to an industrial buyer with no substitute and no flexibility, price becomes irrelevant. They pay whatever. clears the market, and the paper market cannot stop that. It can only delay it. But delay increases pressure, which is why every smash increases the eventual blast radius. And this is why calling it a nuclear bomb is not hyperbole. It is descriptive. Because once delivery failures cascade, the repricing is instantaneous across contracts, ETFs, derivatives, and collateral agreements, forcing a jump rather than a climb. And you can already see the pre-shock indicators: volatility compressing unnaturally, options skewing, physical premiums diverging from spot, all signs of a spring being compressed. And the reason the banks are lying is not because they want to destroy silver investors, it's because acknowledging the truth would expose the fragility of the entire system, because silver is woven into monetary confidence through gold, and gold is the mirror of fiat credibility. And when that mirror cracks, policy loses control, which is why official narratives always lag reality, and why today's smash is actually confirmation, not denial, that the reset has been triggered, because they would not expend this much energy suppressing a market that did not matter, and they would not risk credibility unless the alternative was worse, and the alternative is admitting that the paper game has reached its limit. And once you accept that, the rest becomes straightforward arithmetic. If available above-ground investable silver is under 3 billion ounces globally, and only a fraction is liquid, say 1 billion realistically, and the market needs to absorb a 100 million ounce deficit annually, you exhaust liquidity in 10 years without investment demand, in 5 years with it, and in 1 year, if panic hits, and panic does not announce itself politely, it arrives after a trigger, a policy error, a war escalation, a currency shock, and suddenly silver is not something you trade, it is something you cannot source. And when sourcing becomes the problem, price resets, not gradually but violently, to a level that chokes demand. And $150 is not a moonshot in that scenario. It is a clearing price that forces substitution, recycling, and demand destruction. And even then, it may not be enough, because silver is not discretionary in many applications. And this is the core misunderstanding retail is fed, that silver behaves like a speculative asset, when in reality, it behaves like an industrial input with monetary optionality, the worst possible combination for a leveraged paper system. And as long as people keep thinking in charts instead of flows, they will miss the signal. But flows never lie. They only get hidden, and right now they are screaming. And the latest update that insiders are watching is not a headline number, but a subtle shift in settlement behavior. More contracts rolling, fewer standing, and the ones that stand are increasingly concentrated, which tells you delivery risk is being managed, not eliminated. And risk management is what happens right before repricing, not after. And if you're still asking why today, the answer is because time ran out, deficits accumulated, inventories thinned, and policymakers painted themselves into a corner with inflation and debt, making precious metals the pressure gauge they cannot allow to spike visibly until they must. And that must moment is approaching faster than sentiment suggests, because sentiment is engineered, but physics is not, chemistry is not, and math is not, and silver lives at the intersection of all three, which is why the reset is inevitable, and why calling it leaked is appropriate, because the market is telling you quietly before it shouts, and when it shouts there is no entry, no calm accumulation, no second chance, just a new price regime that people will later claim was obvious in hindsight, and the only real decision is whether you understand, set up before the blast or after, because after the blast narratives change, experts explain, and the same voices that told you nothing was wrong will tell you it was unavoidable, and by then $150 will not sound extreme, it will sound historical, and the only thing left unresolved is how deep this goes beyond silver into gold, currency confidence, and systemic trust, which is why this investigation does not end here. It only accelerates as more data surfaces and more pressure builds. So ask yourself one question before the next smash. Are you watching the price or the structure? Because one lies and the other cannot. And the structure right now says game over. Not because of hype, but because of mathematical certainty baked into a system that pretended paper could override physical reality forever, and forever just expired. If you stay with me deeper into this evidence trail, the picture sharpens into something far more uncomfortable for the official story. Because once a market reaches this stage, the behavior of participants changes in subtle but measurable ways, and those ways are now visible across silver and gold simultaneously, which matters because gold is the confidence anchor and silver is the stress fracture. And when both start signaling strain, the system is no longer stable, it is adaptive, and adaptive systems under pressure do not gently rebalance, they snap to a new equilibrium, and that equilibrium is always defined by scarcity, not sentiment. And this is why the latest smash should be read as confirmation that internal alarms are ringing, because suppression is a response to fear, not strength. And the fear is not retail buying coins, it is institutional exposure to a promise that cannot be honored at scale. And this brings us to the overlooked mechanism of netting and offsetting that dominates the paper game, where most contracts are never intended to result in delivery, but are designed to cancel each other out through cash settlement, which works beautifully until a growing minority insists on physical, because cash settlement assumes trust in currency stability, and that trust is exactly what inflation and debt have eroded. So more participants quietly opt for metal, not headlines, not viral trends, but treasury departments, manufacturers, and sovereign funds hedging, quietly. And when even a small percentage of these actors change behavior, the impact is nonlinear, because the system was built on the assumption that almost no one would ever do that. And now some are, and the evidence shows up in delivery month anomalies, in unusual spreads, and in the quiet language of clearing members urging flexibility, which is bureaucratic code for stress. And while commentators argue about chart patterns, the real story is flow control. And flow control is breaking down because you cannot conjure silver molecules out of derivatives. And that sounds obvious until you realize how much of the modern financial system is built on the pretense that you can. And that pretense worked for decades because physical demand was secondary to monetary policy. But policy has now cornered itself, and here is where gold re-enters as the shadow driver, because gold has been accumulating in official hands at a pace that contradicts public statements, and that accumulation drains liquidity from the same vaulting and transport infrastructure silver relies on, creating competition at the logistical level, not just the price level, which is another hidden detail mainstream analysis ignores. That metals market share pipes, trucks, refineries, and insurance, and when those pipes clog, the smaller, more industrial metal feels it first, and that is silver. And this is why delays, premiums, and allocation notices matter more than spot prices, because they tell you where friction is building, and friction is the precursor to rupture. And once rupture occurs, the repricing is brutal, because there is no incremental adjustment path left. And to quantify that brutality, you have to understand elasticity, because silver demand is inelastic in critical sectors, meaning price increases do not proportionally reduce consumption, they simply raise costs downstream, and downstream costs feed inflation, which feeds policy paralysis, which feeds more metal demand, creating a feedback loop that accelerates, not stabilizes. And this is the loop policymakers fear because it exposes the lie that inflation can be managed without consequence, and silver is the messenger carrying that truth, which is why it must be silenced until it cannot be. And this is why you should be suspicious of calm narratives during violent smashes, because calm is the mask worn during emergency response, not during normal operation. And to bring this back to the $150 reset level, we need to stress that resets are not valuations, they are regime changes. They reflect a new floor established by scarcity and risk premium, and once established, they are rarely revisited because the underlying conditions do not reverse. They entrench, and the math behind that floor is uncomfortable but simple. Take the cost curve of marginal production, including energy, labor, regulation, and capital. Then add a scarcity premium reflecting inventory depletion risk. Then add a monetary premium reflecting currency debasement hedging. And finally, add a risk premium reflecting delivery uncertainty. And when you stack those layers, you quickly surpass triple-digit pricing without invoking speculation at all, and that is before panic, before headlines, before retail frenzy, which means $150 is not a blow-off top number. It is a baseline clearing price in a stressed system. And stressed systems do not resolve stress by lowering prices. They raise them to choke demand. And this is where gold amplifies the effect, because as gold continues to be accumulated quietly by central entities, it drains confidence from fiat indirectly, making silver more attractive as a leveraged expression of that loss of confidence, and leveraged expressions move faster and further, which is why silver historically overshoots gold on the upside during monetary resets, and why every attempt to frame silver as merely an industrial metal misses the point, because its dual nature is exactly what makes it dangerous to the paper system, and this danger is now being acknowledged internally even if denied publicly, as evidenced by changes in margin requirements, reporting standards, and delivery terms that are framed as routine but timed suspiciously close to stress events. And routine changes do not cluster like this unless driven by necessity, and necessity is the fingerprint of shortage, and shortage is the enemy of leverage, because leverage assumes abundance, and abundance is gone, not geologically, but economically, which is all that matters. And if you still doubt this trajectory, consider a hypothetical stress test. Imagine just 10% of outstanding paper silver claims sought delivery over a 6-month window. Not all at once, not a bank run, just a slow conversion. The system would fail, not because 10% is large, but because the buffer is thin, and thin buffers collapse suddenly. And that collapse would not be negotiated quietly. It would be visible, messy, and confidence-shattering, which is why suppression continues aggressively, because preventing that test is the only way to maintain the illusion. And illusions are maintained until the cost exceeds the benefit, and the cost is rising every day through deficits, depletion, and distrust. And this brings us to the geopolitical layer, because silver and gold are not neutral assets. They are strategic, and strategic assets become flashpoints during conflict, and the world is not moving toward harmony. It is fragmenting, which increases the incentive for states to secure tangible reserves, and tangible reserves are not paper promises. And when multiple states act on that incentive, simultaneously the market experiences what looks like irrational price behavior, but is actually rational hoarding. And hoarding is indistinguishable from shortage to the market, which again pushes price higher until someone yields. And yielding at $30 or $40 is easy. Yielding at $150 is not, which is why the reset must overshoot to be credible. And credibility is everything in markets, especially after it has been lost, and fiat credibility has been bleeding for years, accelerating recently. And precious metals are the scoreboard, not the cause, and shooting the scoreboard, not the cause. And shooting the scoreboard does not change the score. It just delays recognition, and the delay has allowed imbalances to grow larger, making the eventual adjustment more violent. And this violence is what the term nuclear bomb captures. Not instant destruction, but cascading failure across interconnected systems. And silver sits at a node where industry, finance, and policy intersect. So when it moves, it transmits shock widely, and that shock will force narratives to change overnight, from dismissal to inevitability, from mockery to explanation. And by then, the window to position will be closed, and positioning is not about trading, it is about understanding, because understanding precedes action, and action taken late is reaction, and reaction is always punished. And that is why this analysis matters now, not after confirmation, because confirmation comes with cost. And the cost will not be measured only in price but in trust, and trust once broken is not easily repaired, which is why the reset is final, not cyclical, and why attempts to frame the coming move as a bubble are intellectually lazy, because bubbles require excess supply chasing speculative demand, and silver has constrained supply chasing essential demand, which is the opposite condition. And the longer this is misunderstood, the more violent the correction becomes, and the more obvious it will look in hindsight. And that hindsight will fuel endless documentaries, reports, and retrospectives, asking how no one saw it coming, even though the data was there all along, buried in boring reports, lease rates, logistics, and quiet policy shifts. And if you are still listening, you are already ahead of that curve, but the curve does not stop here. Because beyond $150 lies a deeper conversation about monetary architecture, gold's role, and whether trust can be rebuilt without anchor assets. And that is a conversation the system is not ready to have publicly, but it is being had privately right now, which is why these signals are accelerating, not fading, and why the urgency in this voice is not theatrical, it is analytical, because time is the variable that has run out. Not silver, not gold, not demand, but time. And once time is gone, all that remains is repricing. And repricing does not negotiate, it enforces, and the enforcement mechanism is price. And price is about to do the talking, loudly, violently, and without apology, which leaves only one decision for anyone paying attention: whether to understand the mechanics now or to be told the story later, when the story no longer offers options but explanations, and explanations are cold comfort in a market that is already reset. And this investigation is far from complete because every layer peeled reveals another beneath it, tighter, darker, and more consequential. And the next layer involves how gold and silver interact with currency swap lines, sovereign debt, and confidence itself, which is where this deep dive is headed next, unless you want the synthesis and the final conclusions drawn now before events overtake analysis. So tell me plainly, and that brings this investigation to its unavoidable close. Because once you strip away the headlines, the distractions, the coordinated smashes, and the comforting narratives, what remains is a market staring straight at physical reality, where silver is no longer priced as a commodity but exposed as a structural fault line in a paper game, stretched past mathematical certainty. And whether the reset prints at $150, overshoots it, or detonates through it is no longer the real question. Because the real question was always whether this system could reconcile infinite claims with finite atoms, and the answer is no, not gradually, not politely, but through a violent repricing that history will later label obvious, inevitable, and mismanage. And when that happens, the same voices that laughed at this analysis will rebrand it as foresight. The same institutions that denied shortages will call them temporary dislocations. And the same banks that lied will claim they warned everyone. Which is why documenting this moment matters, why understanding it matters, and why staying with the original matters. Because markets don't reward noise, they reward clarity before consensus. And if this breakdown of the silver and gold structure changed how you see price, supply, and power, then make that signal visible, like the video, so the algorithm can't bury it. Share it with someone who still thinks this is just another cycle. Subscribe so you don't miss what comes next as this reset unfolds in real time. And most importantly, comment below with what you think breaks first: the paper market, the delivery system, or currency confidence itself. Because this conversation isn't ending here. It's only just beginning, and the next move will not ask permission.